Hi, welcome to Black and White Crypto. I'm White. Another beautiful day in the market. Happy to be back on camera. We got some great stuff to talk about. We're going to be doing something a little bit different today. We're going to be talking about crypto tax and kind of understanding what I need to do and how it all works. We'll talk about it like we're all beginners here. So if you are new here, first things first, hit that subscribe button, hit that like button for me. I appreciate all the support. I really do. Let's jump right into it. So, cryptocurrency is going to be considered a capital asset by the IRS, and those are going to be the guidelines that we're going to be working under. So, a couple things before we get into the questions. Let's explain what a capital gain and a capital loss is. So, a capital gain is only going to be on a completed transaction or a completed trade. Now, for that, we'll use an example. If I buy $1,000 worth of Bitcoin, it is only going to be a taxable event once I either buy or sell that amount of Bitcoin that I purchased. So we'll use $5,000. At that point, I have $4,000 worth of profits that I have to pay taxes on. So it kind of leads into the first question. How do I know if I need to pay taxes on my crypto? So the only time you pay taxes is, again, when you complete the transaction or the trade. So when you sell it, that is when you will pay. So keep that in mind. How much will I owe in taxes if I buy crypto? So you're gonna be adding up all your losses and your gains depending on all the transactions that you made, and then based on the gains you'll kind of know how much you need to be paying, and you'll know that based on whatever your tax rate is for where you live. Now, kind of gives me a chance here to jump into long-term and short-term capital gains. Now, a short-term capital gain is going to be any trade that is completed within one calendar year, so 365 days. So if I buy $1,000 worth of Bitcoin and I sell for $5,000, that's $4,000 that will go on top of whatever income I make that year, and then I will be taxed at that rate. So kind of keep that in mind when you're doing any of these short-term trades. Now, when it comes to long-term tax rates, they're actually a lot lower than your normal short-term capital gain tax rates. So they kind of incentivize us to hold these assets longer. It's very similar to stocks in that way. So here's a good question. If I get rewards or interest for staking or lending out my crypto, do I have to pay taxes on those rewards, that interest? Unfortunately, the answer is yes to this, and it's because these rewards are considered interest income. So what that means is, as soon as you receive these rewards, and let's just use the example is I'm staking Bitcoin, so they give me Bitcoin, or I'm staking Ripple and they give me Ripple, then at that moment, the fair market value that I get in rewards, I have to pay and I have to report as a short-term capital gain. And, and like I mentioned before, you get taxed at the same rate you would for like a 9 to 5 job, whatever tax bracket you kind of jump into at that point for that 1 year. Let's see. Here's a good question. How do I know if the IRS is getting all my information? Now, I kind of have a rule of thumb here. Law-abiding platforms like Coinbase, KuCoin, Crypto.com, a lot of the bigger ones, they're going to have sections within their sites or their apps where they have tax options for you and all your transactions laid out. And I like to say again, if they're showing you that information, if they're helping you report that information, they're already sending that information to the government and to the IRS. So if you're on sites that are smaller, or if you're dealing with swaps or wallets that aren't reporting this information, well then at that point, all that liability then falls upon you to report it. And the IRS will have no access to this information, and it will be in the blockchain. Another good question. Can I reinvest my crypto profits? No. As soon as you complete the transaction, that is a taxable event. So I kind of use this like real estate. So typically, when you sell real estate, you can roll that money into another like kind property, and you can kind of defer the taxes that you would have to pay on that realized gain. The IRS has kept it very black and white on this. You can't just roll your crypto into more crypto and then not have to pay taxes on that. So, unfortunately, that's obviously the way we would all do it, but you can't do it like that. So biggest thing, just to wrap it up, if you got questions, just message me. I hope this was pretty straightforward. Losses are deductions. Losses are more important than gains. Reporting your losses is like a penny saved is a penny earned. You know, it's the way I believe. You report $100 in losses, you save $10 in whatever gains you had. You know, so yeah, I think I pretty much covered a lot of the basics there. Let me know what you think. Hit that like button. This is Black and White Crypto. I appreciate all the support.